Hello all and welcome to this TDW Tech Bite. Today we're going to speak about the dreaded down round. Yes, this is a talk on venture capital and one of the issues many founders are facing right now, the down round. In the next 5 minutes I'm going to tell you what is a down round, I'll tell you the perspective of your existing investors to a down round, and I'll explain 3 types of anti-dilution protection and tell you what you should do to make sure that you're on the right side of these issues. So first, what is a down round? Well, a down round, quite simply, is an investment round in which the valuation, the price per share that is offered, is less than the price per share or valuation that was achieved in the previous round. In other words, your business is worth less now than it was when you last went out to take external investment capital. That's a down round. It happens in this scenario. Well, look around you. It's happening right now. Because what's happening now is that you had a particular runway that was going to help you to survive until a particular period of time. Your business was going to grow in that period of time. You could become self-sustaining and you could go on and conquer the world. Now, the runway is getting shorter, the revenue is getting less, and you need the money. If you go to the market in these financing conditions, very likely you're going to face a lower valuation than you may have achieved in the last investment round. This is the scenario. Well, let's look at how your existing investors might look at this situation. If I'm an investor and I put money into a company, in my mind I've put money into a company to get a specific percentage of the equity at a specific valuation. Now, if that valuation goes down, I still have, all other things being equal, the same equity percentage, but it's a smaller pie. That doesn't seem fair to me. Given the amount of money that I've contributed in the expectation of that having a particular valuation, I should, in fairness, have a bigger piece of the smaller pie. And the way investors approach this is they ask for something that is called anti-dilution protection. And that comes in 3 species. There is full ratchet protection. I know that sounds painful. There is broadly based weighted average protection. And there's narrow based weighted average protection. So what is full ratchet protection? This is a situation where if there is a down round, meaning that there's a lower price per share in a future round, then an investor who already has this protection can apply that lower valuation, that lower price per share, to the amount of investment capital that he's contributed to the company. The net effect of that is that he will receive additional shares or additional percentage of any exit proceeds. That can either be done by the issuance of shares at the time or by an adjustment to the conversion price and to the conversion ratio. Basically, he gets more shares. The next type of anti-dilution protection is a variation of that, and it is called narrow-based weighted average protection. The difference between a full ratchet protection and a narrow-based weighted average protection is that a narrow-based weighted average protection will do a weighted average taking into account the number of shares that are being issued in the down round. Because in a full ratchet, the variation occurs even if the only 1 share is issued in the down round. So you could have a big effect from a small number of shares being issued. If you use a weighted average basis, it evens that out and it makes it more fair. Why is it narrow-based as opposed to broadly based? Narrow-based only takes into account shares that have actually been issued. So it doesn't take into account convertible rights or option rights that might convert into shares in the future. That is what is a broadly based weighted average. Now, if you're a founder, what you want to try and negotiate for is a broadly based weighted average anti-dilution. Of course, your ideal is not to have any of this anti-dilution protection at all, but once you get to a pre-Series A or a Series A stage, it's very difficult to hold that position out. So you'll be looking for a broadly based weighted average anti-dilution protection. But What if the horse is bolted? What if you're facing this right now? Well, what you should do right now is to look at your documents and run the maths. Do the numbers, do the figures, because what is ultimately going to happen in a down round is you are going to be diluted more. So you want to know exactly how much you will be diluted and factor that into the metrics you're going to run as you go and approach investors looking for investment capital in these difficult times. So those are my tips for managing in negotiations for down rounds with venture capital financing right now. Tune in for the next TDW Tech Bite.